A lot of investing mistakes start the same way. Everything looks fine until one small error causes a big problem. That is why smart investors do not just ask, "Can this work?" They ask, "What protects me if I'm wrong?" This idea has a name, and it is one of the most important concepts in investing. It is called the margin of safety. At first, it sounds technical, but the idea is actually simple, practical, and very human. It means leaving room for mistakes. Because mistakes will happen. That is the big lesson. Good investing is not about being perfect. It is about being protected. Imagine you need to cross a bridge. Would you rather walk across one that is barely strong enough, or one built with extra strength, extra space, and extra support? Most people would choose the safer bridge. That extra strength is the margin of safety. It gives you protection when conditions are not ideal. Investing works the same way. You want decisions that can survive imperfect outcomes. Think about climbing a ladder. A shaky ladder might hold you, but it gives you no comfort. A strong ladder with solid support gives you confidence. That is what safety feels like in real life. Now bring that idea into investing. Every investment has a price, and every business has an underlying value. If you pay more than something is worth, your room for error gets smaller. Even a small disappointment can hurt you. But if you buy below what you believe it is worth, you create a buffer. That buffer is your margin of safety. In simple terms, smart investors prefer buying good businesses at sensible prices, not stretched prices. Why? Because valuation is never perfectly precise. You are estimating, not measuring, with total certainty. Your numbers can be off. Your assumptions can be wrong. The future can surprise you. So the goal is not perfect prediction. The goal is to leave enough space for normal human error. That is why the margin of safety is so powerful. It turns uncertainty from a disaster into a manageable risk. Think of carrying something fragile. You do not toss it into a cart and hope for the best. You add padding. You protect it. You prepare for bumps before they happen. That extra protection is not pessimism. It is intelligence. Investing is the same. A margin of safety is financial padding around your decision. This is why smart investors study businesses carefully. They want a reasonable estimate of value before acting. Meanwhile, the market tries to distract you with noise, speed, and emotional headlines. But great investing often starts by slowing down. Ignore the noise and focus on what matters. Look at the company's earnings, debt, cash flow, and strength. Those facts matter more than excitement. And here's a key mindset shift. Hope is not a strategy. Safety is. You do not want to rely on everything going exactly right. You want to be okay even if things go a little wrong. Imagine throwing darts at a target. Hitting the exact center every time is hard. That is what investing feels like when you demand perfect accuracy. It leaves no room for normal mistakes. A margin of safety gives you a wider safe zone. You do not need perfection to still do well. That is why careful investors examine the business itself, not just the stock price. They check the balance sheet, the cash flow, and the quality of the business. They are trying to reduce avoidable mistakes because deep down, every good investor accepts one honest truth. You will not be perfect. The future is uncertain, just like the weather. You cannot control every storm, but you can prepare for it. That is what wise investing does. Preparation is not fear. It is calm realism. A margin of safety is like bringing an umbrella before the rain starts. It keeps small surprises from becoming big disasters. Or think of a seatbelt in a car. You do not wear it because you expect a crash every day. You wear it because protection matters when life becomes unpredictable. That is the right spirit for investing too. Protect first, then grow. This mindset may feel less exciting than chasing quick gains, but it is much more durable. When prices are flying higher, people often forget about risk. That is when mistakes become expensive. Smart investors stay disciplined. They do not chase just because everyone else is excited. Instead, they check their assumptions, review their notes, and wait for a safer opportunity if needed. That is why good investing is really a game of risk control. Avoiding big losses matters enormously. In the end, you often face a choice between excitement and discipline. Excitement feels fast. Discipline feels boring. But discipline is what keeps you in the game. The investors who last are usually the ones who protect themselves first. Then they let time do the heavy lifting. So if you remember one thing, remember this. The margin of safety is your buffer against being wrong. It helps you avoid big mistakes. And in investing, avoiding big mistakes is a huge advantage. Buy with a buffer, not with blind optimism. That simple habit can change everything. Preparation beats prediction. You do not need to know the future perfectly to invest wisely. You just need enough humility to prepare for uncertainty and enough discipline to act carefully. That is what makes the margin of safety such a powerful idea. It respects both opportunity and risk. If you want more simple investing lessons like this, subscribe and stay for the next video. And if you want to support the channel, you can become a member or join on Patreon. Thank you so much. Until next time, remember, smart investing is not just about making money. It is also about avoiding unnecessary mistakes.